Hello all of you. Now we'll start with question number 9. Extra limited and non-listed company furnish you with the following balance sheet as at 31st of March 2021. Rupees in lakhs. Now equity and liabilities shareholders fund share capital note 1 120, reserve and surplus note 2 118. Then non-current liabilities long term borrowing note 3 4, current liabilities trade payable 70, total 312. Non-current assets property plant and equipment 50. Then non-current investments 120. Then current asset cash and cash equivalent 142. Now your notes to account share capital authorized issued and subscribed capital equity share of rupees 10 each fully paid 100, 9% redeemable preference share of rupees 100 each fully paid 20, total 120. Reserve and surplus capital reserve 8, revenue reserve 50, securities premium 60, total is 118, long term borrowing is 10%, debenture 4. The company redeemed the preference share at a premium of 10% on 1st of April 2021. What does it mean? Here company doing the redemption. The first point is related to redemption of preference shares. Redemption of preference shares. It also bought back 3 lakh equity share of rupees 10 each at rupees 30 per share. The payment for the above was made out of huge bank balance. Second point is related to buyback of share. Second point is related to buyback of shares. The third point, included in its investment where investment in own debenture costing rupees 2 lakh, face value rupees 2.2 lakh. These debentures were cancelled on 1st April 2021. This point is related to cancellation of own debenture. We have just cancellation of own debenture. Cancellation of own debenture. We have already discussed about these 3 points in previous question also, that is redemption of preference share, buyback of shares and cancellation of own debenture. Now this point number 4 is new for you. The company had 1 lakh equity stock option outstanding on the above mentioned date to the employees at rupees 20 when the market price was rupees 30. This was included under current liability. On 1st of April 2021, employees exercised their option for 50,000 shares. Pass the journal entries to record the above and prepare the balance sheet as at 1st of April 2021. So you can easily pass entry for first redemption of preference share, buyback and for cancellation. We have already discussed about these points in previous question. But this is new for you. It's called ESOP, Employee Stock Option Plan. The name of chapter is not redemption of preference share, is not cancellation of own debenture, and is not ESOP. The name of chapter is buyback. But what happened? This redemption of preference share, this cancellation of own debenture, and ESOP. There were separate 3 chapters on it. You know, in old syllabus, there was a chapter on it: redemption of preference shares, cancellation, redemption of debenture, and ESOP. Now these chapter is part of now CA Foundation. Redemption of preference share and redemption of debenture now a part of CA Foundation. But it's okay. It's adjustment related to redemption of preference share, cancellation of own debenture. They also cover here comes in buyback of share. So we don't have to worry because we have already discussed about this redemption of preference share, cancellation of own debenture. Here, especially in this question, in detail, we will discuss this 4th point that is related to ESOP, which is new for you. We will discuss in detail what is the ESOP, what is the concept behind ESOP. So we will start first passing journal entry, start from point number 1 that is related to redemption of preference shares. So write down there question number 9, page number 13. So journal entries in the books of extra limited rupees in lakhs. Now draw this for, it will take 1.5 page or 2 page, so many journal entry. Okay, so at least initially draw for 1.5 page. Okay, Draw for 1.5 page. Okay. So date, particulars, amount. Okay. So first we will pass entry for. First point is related to redemption of preference shares. Okay. First point. So you can give the heading there. Redemption of preference shares. Redemption of preference shares. Okay. So first entry that is on 2021 April 1st. Okay. So what entry we pass when we do the redemption? We just cancel the capital and that amount we are liable to pay to shareholder. So how much we are doing redemption at 10% premium. Okay. What is the amount of preference shares here? Share capital note 1. So go to note 1. You can see the amount of preference share is 20. All amount is lakhs. So 20, it is 20. So decrease the capital. We decrease the capital, decrease in capital, debit. So 9% preference share capital. We don't purchase preference shares market. So we just cancel the share capital, decrease in capital, debit. So preference share capital account debit. How much? Write down rupees in lakhs, 20 lakhs. We are paying premium. So here premium on redemption of preference shares account debit, which is 10% of this 20 lakh. So 20 lakh multiplied by 10%, we are paying premium 10%. So that's come 2. So to preference shareholder account. To preference shareholder account. How much? 22. Being redemption of preference shares due, because we are liable to pay to preference shareholder. How much we are liable to pay to preference shareholder? We are liable to pay 22 lakh. So to preference shareholder. Now we will pay to preference shareholder. So preference shareholder account debit to bank account. So preference shareholder account debit 22 lakhs to bank account 22 lakhs. So preference shareholder account debit to bank account. Being payment to preference shareholder on redemption. Now after this, how much amount we have to transfer to CRR? Because same rule. We have already discussed this redemption of preference share. To remember these entry that we have discussed for the redemption of preference share, these. The first, preference share capital account debit, premium on redemption of preference to preference shareholder. We have done the payment, preference shareholder account debit to bank account. And we have to adjust the premium on redemption of preference share. I will discuss about this premium on redemption of preference share later. At the end of this question, I will pass the entry for the premium redemption of preference share. I will discuss. There is some important point I will tell you there. The premium redemption of preference share we will discuss about. We have to write it off. I am coming to fourth entry now. So we have to transfer to CRR. How much we have to transfer to CRR? So the face value of preference share redeem is how much? 20. The 20 we have to transfer to CRR. How much balance we have? Okay. So how much balance we have? Just 1 minute. How much balance we have? 20. We have revenue reserve. We have 50. Okay. So we have 50. One more important thing. Let me write for your reference. I am writing here. That premium on redemption of preference share will write off at the end. I will discuss there. Don't worry. We'll write off at the okay. We'll discuss about there. So now we have to transfer to CRR. So revenue reserve account debit to CRR. So revenue reserve account debit. Revenue reserve about these two amount. We'll discuss later. The revenue reserve account debit 22 capital redemption reserve account 20 being face value of preference shares redeemed out of profit transferred to capital redemption reserve account as per law. Now we have passed entry for redemption of preference share. We will discuss about this, that premium or redemption of preference share, to write it off. We will discuss about it at the end and we will pass entry there. Now second point related to buyback. So you know it. So we will purchase the shares, then we will cancel it, then we'll if it is at premium, yes it is at premium, we'll write it off premium and then we'll transfer to CRR because it is out of profit. Nothing is mentioned about the issue of shares in the market. So write down here, give the heading buyback of equity shares. Buyback of equity shares. Okay. So write down there. First we'll purchase it. Equity share buyback account debit. Equity share buyback account debit. We are doing buyback of how many shares? 3 lakhs. Okay, at rupees 30. Face value is 10. So equity share buyback account debit. 3 lakh shares. For 1 share we are paying 30 rupees. So 3 multiplied by 30, that's come 90 to bank account. To bank account now. To bank account 90. Being 3 lakhs equity shares, 3 lakh equity shares of rupees 10 each bought back at the rate of rupees 30 per share, Okay. Now we have purchased the share, equity share. Now we have to cancel it. Decrease in capital, debit. So equity share capital account debit. Equity share capital account debit. That is 3 lakh shares. Face value rupees 10. So that's come equity 3 multiplied by 10, 30. Premium on buyback of premium on buyback account debit 3 lakhs share multiplied by rupees 20 is premium. So 3 multiplied by 20, that's come 60. To equity share buyback account. Buyback account. That is 90. So being cancellation of shares bought back. Now understand this part. What happened here? Being cancellation of shares bought back. What happened? You have debited here equity share buyback account and here you have credited. It is cancelled now. Here what happened? You have credited here preference shareholder account and you have debited preference shareholder account. So that account get cancelled. Now you will tell me, sir, now pass entry to write off this premium on buyback also. For premium on redemption of preference share and premium on buyback of share, We'll do that at the end of this question. We'll do that, don't worry. So for your reference, I am writing here because at the time of revision, you may get confused, sir has not passed the entry for premium to write off the premium on buyback or premium on redemption of preferential. That will do at the end of this question. So have patience. So for your reference, you can write down here premium on buyback will write off at the end. Don't worry. Write off at the end. Okay. Don't worry. Okay. Now we have to transfer to CRR. I will tell you why we will pass at the end. Don't worry. Okay. So we have to transfer to CRR. So how much the face value of buyback? That is 30. So 30 we have to transfer to CRR. So out of this revenue reserve is how much? 50. We have utilized how much? 20 to transfer to CRR at the time of redemption of preferential. Now at the time of buyback of share, that is 30. So how much balance we have in revenue reserve? We have here 50 minus 20 that we have utilized, remaining is 30. So 30 will utilize at the time of buyback now. So 30 it will come 0. Okay. So now here pass next entry. Pass next entry. Okay. So write down here third entry now. Next entry here. Revenue reserve account debit. Revenue reserve account debit 30 to capital redemption reserve account 30 to capital redemption reserve account 30 being face value of buyback of shares out of profit transferred to CRR account as per law. Now we have passed entry for buyback of share. Now we will pass entry for cancellation. Third point, that is cancellation of own debenture. So we have discussed this in previous question also, the same point. That in investment we have purchased our own debenture. In the market we have issued debenture. The face value of is 2.2 lakh face value. So we have issued the debenture of 2.2 that we have purchased our own debenture. So the face value is 2.2 and we record debenture at face value only, like capital. We always record capital at face value. Same for debenture also. We always record debenture at face value. So what is the face value of debenture that we have purchased from market, which is reflected under investment on asset side? So we have purchased the debenture of rupees 2.2 at rupees 2. This is the cost. This is the purchase price. We have purchased at rupees 2 lakh. And what is the face value? This is face value 2.8. So 2.2, sorry. So it is reflected on liability side. This 2.2, it is reflected on which side? This is liability side. And we have purchased, this is investment, this is asset. So the debenture is of, wait, here how much is debenture? 4. Out of 4, we are discussing about 2.2. Okay. So out of 4, 2.2 debenture that we have purchased from the market at what price? 2 lakh. So here investment which is given in balance sheet is of rupees 120. Out of 120, we are discussing here only for 2. Okay. So here debenture is of rupees 2.2, the face value. So it is recorded at 2.2 that we have purchased this debenture from the market at 2 lakhs. So now we have to cancel it. We will these debentures were cancelled on 1st of April 2021. So we have to cancel this liability and we have to cancel this asset. Decrease in liability. The liability has credit balance. Decrease in liability, debit. So what entry will pass here? We have already discussed about this point earlier also. If you okay, you can see a decrease in liability. Debenture account debit will debit by face value. Investment decrease in asset, it is by cost, and balance is profit will transfer to capital reserve. So write down here. Give the heading cancellation of own debenture. Cancellation of own debenture. So decrease in liability. So 10% debenture. So write down here 10% debenture account debit 10% debenture account debit. Face value is how much? 2.2 lakhs. To investment in own debenture. Investment in own debenture account. Investment in own debenture account, which is written on investment. Okay, it's a part of investment. Cancel. We are doing cancellation of this investment. How much is the cost? 2. It means we are cancelling the liability of 2.2 by paying 2 only. We are decreasing the liability by 2.2 and we are decreasing the asset by 2. We have a profit. Now it's a profit of how much? 0.2. So it's a capital profit, capital nature profit. It's not a revenue profit. So we'll transfer to capital reserve account. So to capital reserve account, how much? 0.2. You can write it on in bracket, profit on cancellation of own debenture. Profit on cancellation of own debenture. Okay. Being own debentures cancelled and profit on cancellation recorded. Okay. The last part, which is new for you. So we have pass entry for redemption of preference shares, then for buyback of equity shares, then cancellation of own debenture. The last part, which is exercise of ESOP. Now we'll say, what is this exercise of ESOP? I'll explain it, don't worry. First of all, ESOP stand for employee stock option plan. Employee stock option plan or employee share option plan. Okay. So what is this? Understand this point. This is new for you. Okay, this is new for you. So let me explain you. Where can I explain you? Now, okay. Just do one thing. Keep the space for 1, 2, 3, but other entries will also come now where I can explain you. Okay, do one thing. Okay, for 2 entries will come. For first one for the exercise and keep the space for 10 to 12 lines. Keep the space for 10 to 12 lines. Okay, keep the space for 10 to 12 lines. And I'm explaining you the concept of ESOP. Keep the space for 10 to 12 lines. Okay. Now after that, listen here. Now, what is this ESOP? This only one adjustment is given in question, but it is not your fault. What happened with ESOP in previous old syllabus? It was a part of syllabus, that ESOP, and now some syllabus they have shifted to some chapter. They have shifted at CA foundation level. So, a student who come after clearing CA foundation as per new syllabus, they know about it. But those students who are shifting from old to new, or they are coming from graduation, maybe they don't know about this. What is this ESOP? That's why I'm discussing here. Maybe you don't know. That's why I'm discussing here. Now, what is this ESOP? First, understand the concept. Very simple concept. Suppose there is a company. I'm discussing whole concept about the ESOP. Okay, not just concentrate here. Here, first that there is a concept called grant date. What is this grant date? What happened here? Any company, what they want, that their good employee should not shift to any other company. And generally it happens. So many employees, generally in IT industry, Infosys, Wipro, or any other company, even in the big four in C industry also, that the employees very frequently shift to other company. They shift to other company. So any company, if their employees are good, the company don't want that their employees goes to other company. What they do? The company, suppose I am company, I am offering you, you are the employee of my company. Suppose, and I am telling you, I am giving you offer that the market price of the share. I am giving you offer that market price, and don't write. If you want to write it down. But I will share this PDF. You know, daily I share the PDF. Okay, focus on concept first. Suppose the market price is of rupees 30. I am taking the same figure, so it will be easy when we will pass each other. Okay, so market price is of rupees how much? 30. The market price of rupees 30. and but I'm offering you the share is of rupees 30. I'm offering you rupees 20. So I'm giving you offer. We call it exercise price. What we call it? We call it exercise price. Okay. I'm writing in. I'm offering you at this price. This is offer price. The share is of rupees how much? 30. I am offering you at rupees what? 20. It means why I'm offering you at rupees 20? Because I am offering you it lower than the market price so that you can purchase the share at rupees 20. But there is one condition that you should work with the company, whatever mentioned that for the next 3 years, 4 years. I want you to work with my company and I will give you share. The market price of the share is rupees 30. I am offering you at rupees 20. So that 20, that 10 rupees is represent option discount. What we call it? We call it option discount. What we call it? We call it option discount. So what is the market price of share? 30 rupees, sir. I am offering you at 20. And how much discount? 10. 10. But what is this granted? Today I am offering you. I am offering you today. There is a granted. I am offering you today. That is granted that for the next 1 year, 2 years, stay with the company. Work with my company. I will give you the share of rupees 30 at rupees 20. But there is one condition. You have to work with my company for the next 1 year or 2 years. Okay. So what happened here? There is a concept here now. The period that you have to work with the company, we call it vesting period. What we call it? We call it vesting period. What we call it? Vesting period. Now understand it. This is new for you. The grant date is the date on which I made the offer. What is this vesting period? Vesting period, this period you should work with the company for this period. It may be 2 years, 3 years, whatever. Okay. Now what happened? After this completion of vesting period, the employees, those who are still working, those who have covered this vesting period, some employee may left the company during this vesting period. Some is still working with us. So I am giving them offer. How many shares? Here it is mentioned question. I am taking same figure. 1 lakh equity option. Okay. So here I am giving 1 lakh shares. 1 lakh share option. To purchase this 1 lakh share, the share of one share is of rupees, market price is rupees 30. I am offering you at rupees 20. So I am giving a discount of rupees 10. But I am giving after the completion of vesting period, I am giving you some time to purchase this share. That period is called exercise period. That period is called exercise period. What we call it? That period is called exercise period. So what is this vesting period? Vesting period is the period that you have to work with the company. After the completion of this vesting period, I am offering you share of rupees 30 at 20 and you can purchase in this period. After the vesting period, I will give 6 months, 1 year, whatever. During this period, you can purchase this share. We call it exercise period. What we call it? We call it exercise period. Now what happened here? The name of this ESOP, what is the ESOP stand for employee stock or employee share option plan. I am giving you option. So I am giving you option for 1 lakh share. It is not compulsion that you have to purchase 1 lakh. You can purchase less than 1 lakh. Suppose you are purchasing here. I am giving you option. It is not compulsion. Employee stock option plan. It is option, not compulsion. So out of 1 lakh, maybe you want to purchase only 50,000 shares. It's okay. So how many shares you want to exercise? You want to exercise only 50,000 shares. How much I am offering you? I am offering you 1 lakh shares. Out of 1 lakh, you want to purchase 50,000 shares. So out of 1 lakh, you want to purchase, how many shares you want to purchase? You want to purchase 50,000 shares. Now understand this part. What happened here? We call it exercise period. Now what journal? Here we have to pass, here in this question, we have to pass journal entry of this exercise period, exercise of shares. So before I come to exercise, I am discussing here journal entry that we pass during the vesting period. So here in the question, we have to pass entry for exercise period only. But before that, we have to pass for vesting period. So for your knowledge, I am discussing journal entry for vesting period. After that, I will discuss exercise period, then we will come to question. Okay. Now what happened here? This entry will pass journal entry during the period of during the period of vesting period. During the period of vesting period. Now what happened? How much is the discount? The amount of discount is 10 rupees. The share market price is 30. I am offering you at 20 and the discount is of rupees 20. Sorry, discount is of rupees 10. So if you stay with the company for the next 2-3 years, I will give you share of rupees 30 at rupees 20 during this exercise period. You can purchase it. But first we have to work with the company. That what we call it vesting period. But during the vesting period, we know that the share is of rupees 30. I am offering at rupees 20. It means there is discount of rupees 10. So as per the conservatism approach, we have to write it down this rupees 10 here. So during the vesting period, we pass entry employee compensation, expenses account debit, employee compensation expense account debit. How much it is? 10 rupees per share. 10 rupees per share. How many number of shares? 1 lakh. So 1 lakh shares multiply by rupees 10, that's come 10 lakh. That's come 10 lakh. Okay. 2 ESOP outstanding. 2 ESOP outstanding account. How much? 10 lakh. How much? 10 lakh. What happened? We have passed the entry employee compensation expense account debit 10 lakh to ESOP outstanding. What is the employee compensation expense account, beta? This employee compensation expense, it will transfer to profit and loss account. It will transfer to profit and loss account, and here this ESOP outstanding will be reflected under reserve and surplus. It will be reflected under reserve and surplus. I will tell you why it will be reflected under reserve and surplus. You will come to know when I will pass entry for exercise period, because this ESOP outstanding will utilize at the time when the employees will purchase this share, and ultimately it will be converted into share capital and securities premium. I will tell you, don't worry. But where this employee compensation expense will go? Employee compensation expenses will go to profit and loss account. So entry will be P&L account debit employee compensation expense. What about the ESOP outstanding, which will be reflected under reserve and surplus during the vesting period? Now after the completion of vesting period, then these employees purchase this share. So it is not necessary they will purchase the whole amount of share that we are offering them. They have option. It is not compulsion. So they want to suppose purchase 50,000 shares. So what entry will pass here? So here journal entry during the period of exercise period. So what entry will pass? So if you purchase this share is of rupees 30, you are purchasing at 20. It means you are giving me 20 rupees per share. So I will pass entry here. Bank account debit. How many shares you are purchasing? 50,000 shares at the rate of rupees 20. So 50,000 multiplied by 20, that's come 10 lakh. So here 10 lakh. Bank account debit 10 lakh. Okay. Now 2. Keep the space for my first lesson. Don't write. Keep the space for one. Just first lesson. 2. I am issuing share. Equity share capital account. Share is of rupees 50,000. Sorry, number of shares is 50,000. The face value. Capital always be recorded at face value. Okay, sir. The face value is rupees 10. So 50,000 multiplied by 10. That's come 5 lakh. Okay. So bank account debit 10 lakh to equity share capital. Now remaining will go to securities premium account. 50,000 shares. Now remember one thing. When I say securities premium account, don't tell me that we are offering them at rupees 20 and the face value is 10. It means the remaining represent securities premium. No. The market price, when we write it down here in securities premium, the market price is of rupees 30. What the market price? Market price is of rupees 30. We are offering them at rupees 20. You are offering them at rupees 20. Okay. So, but how much is the face value? Face value is 10. So, here market price. This is market price minus face value. Market price minus face value. The market price of the share is 30. We are offering them, face value of 10. So, 30 minus 10. That's come rupees 20. The securities premium, don't tell me the difference of where offer price and the face value. Difference market price and face value. The market price is 30, at face value is 10, so 30 minus 10, 20. 50,000 multiplied by 20, that's come 10 lakh. Now you will tell me we have debited. Please wait, have patience here. So important point here. So here this 20, 10 and 20. Understand? What is this 20? That the amount you have received. Amount you have received. What is this 10? This 10 represents face value. What is this securities premium? Securities premium is market price minus face value. What is this securities premium? Securities premium is market price minus face value. Market price minus face value, that is securities premium. What is this rupees 10? This is face value of share. Okay. Now what happened here? You have debited here by 10 lakh, but credited 5 plus 10, 15 lakh. What about the balance is coming here? 5 lakh. What about this 5 lakh? Now, very important point. What about this 5 lakh here? Okay. Now what happened here? You will debit here 5 lakh rupees, but how we have calculated 5 lakh? This 5 lakh represent the amount that we have, the discount amount it represents. You have recorded here 20, see here 20, and here 10 plus 20, 30, 10 plus 20, yes sir, 30, and here you have received 20. So out of 30, 30, 10 plus 20, 30, how much you have received? 20. So remaining 10 is what? Discount. So discount, for discount we have already passed entry in past, employee compensation expense to ESOP outstanding. So these employee compensation expenses that we have transferred to P&L account. What about the ESOP outstanding? ESOP outstanding reflected under reserve and surplus. Now we will utilize this ESOP outstanding. So you will debit here ESOP outstanding account debit. That is 50,000 shares multiplied by rupees 10. What is this rupees 10? This rupees 10 represent the amount of discount. This is new for you. Rupees 10 represent the amount of discount. So bank account, understand this point. 10 plus 20, 30 rupees. Okay. But how much we have received? 20. So this 10 is discount amount. So here we have already passed the entry for employee compensation expense to ESOP outstanding. This employee compensation expense we have transferred to P&L. What about the ESOP outstanding, which is reflected under reserve and surplus? Now we will utilize the ESOP outstanding, that 50,000 and discount is 10. But one more important, very detailed, we are doing very discussion here. Now what happened here? This 50,000 is the number of shares, that 10 is the discount. How much we are offering them? So when we have passed entry for this discount in past, we have credited ESOP outstanding this 1 lakh shares multiplied by 10. 1 lakh shares multiplied by 10. So 1 lakh share multiplied by 10. But it means the balance in ESOP outstanding is 10 lakh. But you have debited here 5 lakh only. We have debited here 5 lakh only. What about the balance amount? Because out of 1 lakh, they don't want to purchase 1 lakh share. They want to purchase only 50,000 shares. So what about the balance in ESOP outstanding, sir? You have credited here by rupees 10 lakh, but you have debited here by rupees 5 lakh only. The reason is that out of 1 lakh, they want to purchase only 50,000 shares. It's okay, sir. But there is a balance of rupees 5 lakh in ESOP outstanding account. Yes, I agree. You have credited here by 10 lakh and you have debited here 5 lakh. It means there is a balance of 5 lakh in ESOP outstanding account. What we will do for ESOP outstanding now? What we will do for ESOP outstanding? In ESOP outstanding, if there is any balance left after the exercise period, the balance of ESOP outstanding we transfer to general reserve account. Why we transfer to general reserve? Because we have created ESOP outstanding through the P&L account. This employee compensation expense goes to P&L account. That's why the balance any left in ESOP outstanding after exercise period, that we transfer to general reserve. But you don't have to worry that much. I have discussed it so much in detail. But the ESOP outstanding, the adjustment come, just we have to pass here the journal entry. This journal entry of exercise period. We have to pass the journal. Sorry. Just 1 minute. Okay. We have to pass here journal entry for this exercise only. So we don't have to worry for this. The entry that we pass during the period of vesting period and any balance left in ESOP outstanding. No, it is not asked that exercise period is finished. We just, the balance which is left in ESOP outstanding after the exercise period, that we transfer to general reserve. But we don't have to pass that entry. It is not mentioned that exercise period has been over. It is not given in question. We just have to pass this entry. Only this is single entry. But if I directly pass this entry of exercise of this ESOP, you will not understand it. That's why I have discussed the background of it. Okay, so don't worry. Now read this point here. This point. The company had 1 lakh equity stock option outstanding on the above mentioned date to the employees at rupees 20 when the market price is rupees 30. So how much is the market price? 30. I am offering them at rupees 20. But this was included under current liability. Now remember one thing. It is mentioned in question that this ESOP outstanding is reflected under current liability. It's okay. It is mentioned. That's why I am saying it is reflected under current liability. But as per as per schedule 3, ESOP outstanding is not reflected under current liability. It is reflected under reserve and surplus. The logic is that this ESOP outstanding will be converted into share capital or securities premium, and if any balance left in ESOP outstanding after this exercise period, that we transfer to general reserve. So ultimately this ESOP outstanding will be converted into share capital, securities premium, or it will be transferred to general reserve. So it should be reflected under reserve and surplus only, and it is reflected under reserve and surplus only as per schedule 3 also. But it is mentioned in question that it is reflecting under current liability. That's why I am saying it is reflected under current liability. But reality is that as per schedule 3, it should be reflected under reserve and surplus. It's okay. Now, on 1st of April 2021, employees exercise their option for 50,000 shares. For how many shares they exercise the option for? 50,000 shares. So what entry will pass now? Pass entry here. Pass entry here for exercise of ESOP. So pass here. Bank account debit 50,000 shares and you will receive 20 per share. So 50,000 multiplied by 20, that's come 10 lakhs. So rupees in lakhs. So write down 10. ESOP outstanding account debit, this is the amount of discount. ESOP outstanding account debit, 50,000 shares. Amount of discount is 10. It will come 5 lakh. 2. Equity share capital account. 2. Equity share capital account, that is 50,000 share multiply by face value is 10. So 50,000 multiplied by 10, that's come 5 lakh. 2. Securities premium account. Securities premium account, 50,000 shares multiplied by rupees 20. So 50,000 multiplied by 20, that's come 10 lakh. So what is this? How we have calculated this 20, 10, 10, 20? What it represents? This 20 represent amount received. This 10 represent discount. This 10 represent face value. And this 20 represent market price minus face value. Okay. Market price minus face value. Okay. So here, being 50,000 shares allotted under employee stock option plan. Employee stock option plan. Okay. Now last entry that we have to pass to write off premium on redemption of preference shares and premium on buyback. Now understand this point. We'll pass entry here that we have discussed earlier also, that premium on buyback. Now understand this point. Very important now. Now last entry, just last entry. Then we have to prepare balance sheet. Then done. So here premium on buyback. How much premium on buyback? That we can utilize what? Securities premium, P&L or general reserve. Generally we utilize securities premium. But when it comes to write off premium on redemption of preference share, I said avoid to utilize securities premium. Why? Section 133 says 33 does not allow the utilization of securities premium account if AS is followed. If the company is following accounting standard, they cannot utilize securities premium account. They cannot utilize securities premium account to write off premium on redemption of preference share. Okay, that I agree. But what happened here? How much is the, and generally company 99.99% company follow accounting standard, they will follow accounting standard. It means the premium on redemption of preference share should not be write off against securities premium account in general. Yes, I agree. But what happened here? The premium on redemption of preference shares we have how much? 2, and premium on buyback we have 60. So 2 and 60, 62. But when I see here, we don't have any balance here. We don't have any balance here in revenue reserve account. For the premium on buyback, now understand this point. Premium on buyback, I can utilize securities premium, agree. Premium on redemption of preference share, I don't want to utilize securities premium. Okay, as per the Companies Act, because if the company follow accounting standard, they should not utilize securities premium to write off premium on redemption of preference share. I agree. But there should be some other balances. No? There should be balance in some other reserve, like revenue reserve, general reserve, surplus balance of profit and loss account. But do we have balance in other? You can see there is a revenue reserve, yes, 50, but that we have already utilized. We have transferred 20 and 30 at the time of, we have transferred this 20 and 30 to CRR account. So we don't have any balance. So for this premium on buyback which is given in question is 60, premium on redemption of preference share is 2. So this 60 balance I will, first of all we don't have any balance in revenue reserve. So it's okay, but for the premium on buyback I will utilize securities premium. Do we have balance in securities premium? Yes, we have balance of how much? 60. So I will utilize this 60 against the securities premium. But what about the premium on redemption of preference share? First I will give preference to revenue reserve. Do we have balance in revenue reserve? No, 0. Okay, the 60 you have utilized this premium on buyback, 60 and this 60. Okay, but what happened here? Now I want to write it off premium on redemption of preference share. The first preference I will give to revenue reserve. We don't have any balance in revenue reserve. But what happened here, when we have pass entry here, this 60, the balance you have in securities premium that you have utilized for this premium on buyback. It means the securities premium is 0 now. It is also 0, 60 minus 60. What about these 2 premium and redemption of preference share? But when you see here question, in journal entry, you have credited here share securities premium account by 10. So we have enough balance here. It is 60 we have in securities premium and you have credited 10. How much we have in securities premium? We have 60 plus 10. 60 plus 10. We have 70 in it. 70 we have. The first premium on buyback I will adjust 60, the balance we have 10 now. Now this 2, as I said earlier, I don't want to utilize against the securities premium. I don't want to utilize this against the security premium account. But I have no other option but to utilize, but to write it off this premium on redemption of preference share against security premium account. Why? Because I don't have balance in revenue reserve. How much balance we have in revenue reserve? We have 0 balance in revenue reserve. But we have some balance in security premium. So these 2 also will write it off against security premium account. So how much balance will be left in securities premium? 8. So we have 60 is given, 10 we have credited at the time of that ESOP, 70 we have in securities premium. We have first write it off that premium on buyback, balance is 10, and then we'll write a premium redemption of preference share 2. So total 60 and 62 will adjust against securities premium because we don't have balance in revenue reserve. That's why. If there is any, it is not, if you see in the, I am discussing here, we are discussing it in so much detail here. This is the law which says that securities premium should not be utilized if the company follow accounting standard to write off premium on redemption of preference share, which is what law says that. But when you see the study material for the at foundation level or that redemption of preference, it is mentioned there. Okay. But if you see these questions, this same question in the study material, they have not explained all this in detail. But you have to know this is a law. If suppose in the question, if we have some balance in revenue reserve, so these rupees 2, I will not adjust against the security premium account. These rupees 2, that is premium redemption of preference share, I will adjust against revenue reserve. Because we don't have any balance in revenue reserve, that's why I am writing off against securities premium account. So now we will pass entry here, last entry. Now we will pass entry here. Securities premium account debit. Securities premium account debit 62 to premium on redemption of preference share account, which is 2, to premium on buyback account 60, being premium on buyback and premium on redemption of preference shares adjusted against securities premium account. Adjusted against securities premium account. Okay, we don't have, suppose if there is any revenue reserve, a balance in revenue reserve, so what I will do in that case, I will pass into securities premium account debit 60 to premium on buyback 60. For these two, I will utilize revenue reserve. So revenue reserve account debit 2 to premium on redemption of preference share rupees 2. Okay, I will pass this entry. But we don't have any balance in revenue reserve. That's why I am adjusting against securities premium account. Done. Now we have debited there premium on redemption of preference shares and premium on buyback. And here we have credited these two. So that account get cancelled. So we have passed all the journal entries we have discussed in so much detail. Now what we have to do, we have to prepare balance sheet here now. Now draw balance sheet. Okay. Draw balance sheet now. Okay. Balance sheet of Extra Limited as on 1st of April 2021. Rupees in lakhs. Rupees in lakhs. Draw this for a little bit more than half page. Note amount. Equity and liabilities. Shareholders fund. Share capital. Reserve and surplus. Second, non-current liabilities. Say share capital, note 1, reserve and surplus, note 2. Long-term non-current liability, write down their long-term borrowings. For long-term borrowing, note 3. Then fourth one is third year. Write down their current liabilities. Under current liabilities, write down trade payable. Make a notes to account on trade payable also, because there are some adjustment. I will explain, don't worry. Write down your trade payable, note 4. Okay. Now then, total this liability side. Now below this, write down asset. So asset here, okay, asset. Second point, asset here. So asset, write down there non-current asset, under non-current asset, property, plant and equipment. property, plant and equipment, then intangibles, then C, non-current investment, and here in the question PP is there, but only single amount of PP, the bifurcation is not there, so no need to prepare notes to account on it. Make a notes to account on non-current investment. Okay, then second here, current asset. Okay, or in current asset only cash and cash equivalent. Okay, so write down here cash and cash equivalent, cash and cash equivalent. Okay, that's it, total. So one by one write notes to account now. Notes to account. Notes to account. First, share capital. Share capital. Notes to account number one, share capital. Okay. Now first, how much share capital they have, one by one. Note number one is given here. Just give me here. Okay. So here, share capital. Note number one, notes to account number one. How much equity share capital they have? 100. 100 in general entry when we have passed entry for it. So type 100 in calci, 100, and we can write it on detail also here. 100 you have debited here, yes, debited here by 30, so minus 30 and 100 minus 30, that is 70 now, and you have issued here share capital 5, so plus 5, so you have balance of 75 equity share capital. So write down here notes to account number one. Notes to account number one, share capital. Share capital, write down there, equity shares of rupees 10 each, fully paid up. Okay, which is 100. Now we have cancellation of bought back shares. Out of 100 we have cancelled 30 and we have issued at the time of that ESOP. So shares issued against ESOP, employee stock option plan, that is 5. So we have balance of 75. You can also directly write 75, but it's okay. In detail 75. How we have calculated? The 75 will come under in share capital in balance sheet. But you can see here there are preference shares also 20. But that 20 you have debited at the time of redemption of preference share. So you don't have any balance in preference share. So how much it is? 75. So write down here share capital 75. Now I am coming to reserve and surplus. So write down notes to account number 2, reserve and surplus. Second, reserve and surplus. Okay, reserve and surplus. First, how much we have reserve and surplus? Total is 180. Detail is note number 2, that is capital reserve 8. So there is no change in capital. I guess yes. At the time of cancellation we have credited by 0.2. Okay, write down here capital reserve, which is given in question, is 8. But when we have passed journal entry, at the time of cancellation of own debenture, we have credited by 0.2. So here add profit on cancellation of debenture 0.2. How much is total? 8.2. How much is total? 8.2. After this, we have revenue reserve 50. So write down here revenue reserve 50. But we have utilized this revenue reserve 50. We have utilized here at the time of we have transferred to CRR 20 here and here 30. So write down here that less transfer to CRR on redemption. 20. Less transfer to CRR on buyback. 30. So in outer column, it will come 0. It will come 0. Next is securities premium 60. Write down there. Securities premium 60. Now at the time of ESOP, we have credited securities premium by 10 and then we have debited by 62 against to write off premium on redemption of preference share and premium on buyback. So write down here, add shares issued against ESOP at premium, that is 10 less adjusted for premium on buyback 60 and adjusted for premium on redemption 2. How much balance we have in securities premium? 8. One more account we have created for reserve, that is capital redemption reserve CRR. You have credited here by 30 and you have credited here by 20. 30 and 20, 50. So you can write it down here. CRR, capital redemption reserve account. How much it is? 50. Now you can do the total of reserve and surplus. 8.2 plus 8 plus 50. How much is 66.2? Some of you may think, sir, we have a balance of ESOP outstanding which is mentioned in question. You have utilized ESOP outstanding to adjust a discount at the time of issue of shares under ESOP. But why you have not written the balance of ESOP outstanding? I will tell you that ESOP outstanding as per schedule 3 comes under reserve and surplus only. But here I have not written under reserve and surplus. Why? I will tell you later. Just have patience. We will write it down reserve ESOP somewhere. Okay. Now write down this reserve and surplus. That is 66.20. So 66.20. Okay. Now after this, second item here is long-term borrowing, that is 4 lakh. That is 10% debenture. So 4, we are making notes to account number 3. Long-term borrowings, so 10% debentures which is given in question is 4 lakh, and at the time of cancellation of own debenture we have debited by 2.2. So 4 minus 2.2, so we have debited decrease in liability. So here 2.2. How much balance we have now here? Here 1.80. So this long term borrowings 1.80. So write down in balance sheet 1.8. Then trade payable. Now it is interesting. How much balance we have in trade payable? We have 70. So write down here trade payable. Write down here notes to account number 4, trade payable, which is 70. How much it is? 70. Now understand this point. Now what happened here, it is specifically mentioned that ESOP outstanding is reflecting under current liability. Current liability means that trade payable, the amount which is given here. Now you have debited here ESOP outstanding account, and this ESOP outstanding is reflecting under current liability. Basically it should not be reflected under current liability, it should be reflected under reserve and surplus. It's okay, but it is mentioned that ESOP outstanding reflecting under current liability. That's why mentioned in question in question. That's why I'm adjusting this ESOP out. It should be ESOP outstanding, not ESOP account. Sorry, ESOP outstanding account. Okay, ESOP outstanding account. That is a current liability. So what we'll do, you can see that trade payable 70 less trade payable is liability, liability is credit balance. Now we are debiting ESOP outstanding. It means we are debiting trade payable because that ESOP outstanding is under trade payable. So we will deduct adjusted for ESOP outstanding 5. So in outer column it will come 65. Okay, you can write down this 65 in balance sheet. Trade payable 65. Okay, now asset side, PP which is given in question, that property plant in 50, no change in it. 50 as it is, it will come 50. Then intangibles, no intangible. Then we have this. We have this non-current. Notes to account number 5 we are preparing on. Okay, notes to account number 5, non-current investment. Write down there. Notes to account number 5, non-current investment. Non-current investment. How much is non-current investment? Non-current investment is how much? 120. So write down here 120, and we have debited here. We have just 1 minute. Non-current investment cancellation. We have thought credit, not debited. Credited here by 2. We have cancelled it against the debenture, that is 2. So asset as debit balance, we have credited it, so we will deduct it. So less investment in own debenture. Investment in own debenture 2. So in outer column it will come 118. Write down this 118 there. 118. Okay. So in balance sheet, write down here 118. Now last is cash and cash equivalent. If you want, you can make a notes to account on cash and cash equivalent. If you want, make a notes to account on cash and cash equivalent. Notes to account number 6. So write down there. Sixth one, cash and cash equivalent. Cash and cash equivalent. Cash and cash equivalent. Okay, cash and cash equivalent. How much given in question? 142. So 142. Okay, sorry. 142. Now when we have pass entry, first here we have a first entry done, second we have credited, so minus 22. So minus 22. Okay. Now then in here we have credited by 90. So minus 90. Then here we have debited. We are debited by 10. So plus 10. Any other item? No. All done? Yes. So here 142 minus 22 plus 142 minus 22 minus 90 plus 10. That is 40. So write down cash and cash equivalent 40. Now do the total here. 50 plus 118 plus 40. That's come 208. Okay. Now liability side here. 75 plus 66.20, 1.80 plus 65. That is how much? 208. Okay, done. Now we are done with our first chapter, that is buyback of shares. Now few important points here. Now listen carefully with. Now today's homework. First of all, today's homework. So today's homework is balance question homework. So I think that homework is question number. I have written here question number. Question number 5th, 6th, and 8th. 5th, 6th, and 8th. Question number 5th. Question number 5th. Question number 6th, and question number 8 is homework. Now, what happened when you will do the revision before the examination is very important. You don't have time at that time to solve all the question. So write down here very important part, that I call it LMM. What is LMM? Last minute. Last minute. Write down there last minute here. So important question that I have. Okay. First write down last minute mastery. LMM. Okay, LMM. So last minute mastery LMM. Okay. So what is the LMM? At the time of revision, you don't have to solve all the questions. Only these questions. Which question? From class question section. Okay. Class questions section. You know it, na? Class question and practice question. So practice questions section. So from class question, I have written just 1 minute. Class question, first, second, third, fifth, and ninth. How many questions? 5 questions. The total 5 questions here. Here, practice question number 4 and practice question number 8. How many questions? 2. The total 7 questions you have to do. You have to revise. You have to solve at the time of revision. Don't waste your time, because you don't have time when you do the revision. For first time, we will solve all the question. We'll discuss in detail each and every point. We'll discuss in detail each and every point. Okay, it is very important. Now what happened? At the time of revision, just you have to solve these 7 questions. That's it. Okay. Okay. And one more thing, I think that MCQs is given there. Yes. Come to MCQ. The first is as per section 68 subsection 1 of the Companies Act, buyback of own shares by the company should not exceed 25%. 25% of the paid up capital and free reserve. So answer is A. Now, this is given in page number 15. Now here, that the companies are permitted to buy back their own share out of free reserve and securities premium, and then proceed of the issue of any shares. Correct. So here answer is C. That is both A and B. Now third, when a company purchase its own shares out of free reserve, a sum equal to nominal value means face value of the shares so purchase shall be transferred to CRR. Okay. State which of the following statement is true. True. We have to find a true here. So buyback is for more than 25% of the company. This is false. It should not be 25, more than 25. But we have to find it true. First one is false. Second, partly paid up shares cannot be bought back by the company. So yes, they cannot buy. Yes, only when they do the buyback should be fully paid up share. Therefore, the answer is B. They cannot buy back the partly paid up share. This is true. Now here, the premium, that is excess of buyback price over the par paid on buyback, shall be adjusted against the free reserve. It can be adjusted against the securities premium. Answer is both A and B. Okay, premium on buyback, that can be adjusted against securities premium or free reserve. Last one, advantages of buyback of share include to encourage others to make hostile bid. No. Decrease promoters holding. No. We have to increase the promoters holding. Discourage others to make hostile bid to take over the company, as a buyback will increase the promoter. The answer is C. Okay. The advantage is that we discourage others to make the hostile bid, because maximum number of shares hold by the promoters only after buyback. Okay. So done. We are done with buyback of shares. Now tomorrow we start new chapter, that is financial statement of company. Okay. So just do the homework, and at the time of revision, you just have to solve these 7 questions only. Now after this, you can take any question. Take any question from the ICA study material, mock test paper, RTP, previous examination question, any question of buyback. You will easily solve those questions. Okay. So that is for today. Take care all of you. Bye-bye. Now we will meet tomorrow with new chapter, that is financial statement of company.